What's up, traders? So today I'm going to show you my super easy swing trading strategy that brings in almost $9,000 per week. Now, if you're new to the channel, my name is Rashad. I am a full-time options trader, and I bring in multiple six figures a year from the stock market. And I use the money I make from the stock market in order to pay for my entire lifestyle and my family's as well. But this here is my Charles Schwab account. This is showing my gains from the last full week, which was December 30th of 2024 to January 3rd of 2025. And I guess it wasn't a full week because the market was actually closed for New Year's Day, which was last Wednesday. But you can see here I made $9,223.22 last week, which is on par for about an average week for me. But I just showed this really so you know that I know what I'm talking about. But you know, it's not lost on me where I started and where he's brought me from. Just 9 short years ago, I was working at a job making $10 an hour. And shoot, I don't think minimum wage is even that low these days. But I was working at a job working with kids with autism. And while I absolutely love that, and I love making an impact on people, and I believe that's what I was put on this earth to do, it's just my paycheck didn't really reflect the impact I was making. So I do like to always look back and think about where I started and just think of how amazing it is that now I make more in a day than I used to make in an entire month. But he is always good. But I know that those numbers probably look amazing to you, but I definitely want to encourage you, please find a mentor or a community that speaks to what you're trying to achieve before jumping into the stock market aimlessly. Because yes, you may look at these numbers and think that they look amazing, but I've been doing this for a very long time and I know exactly what I'm doing and I built a framework that works. But it wasn't always like that. When I first started trading, I had some initial success and it was basically beginner's luck. But I was doing something called trading earnings, and for the first several weeks, I was making more money than I'd ever made before in my life. And I just knew in my head that it was going to keep going. I was going to keep making more and more. And so I got more aggressive and more aggressive. And then I had a day where I lost $28,000 in a single day. And that hurt. That hurt bad. But I didn't have a mentor. I didn't have a community to walk me through the things that I really needed to be doing effectively in the stock market. And at the size of my account at that time, losing $28,000 was a really big deal. And although it hurt at the time, I'm now very thankful for what happened because it was out of that loss that I started to build and define the framework that I have for trading options now. And had that not have happened several years ago, I would not be bringing in the amount of money that you see now. So just a word from the wise, find a mentor or a community that speaks to what you're trying to achieve. But with that being said, let's get down to business. All right, so the first order of business is to one, make sure you like this video and subscribe, because that will just help me out tremendously. Okay, got it? All right, good. But 2 of the option strategies that I use on a weekly basis are selling puts and selling credit spreads. Now, if you're already familiar with selling puts and credit spreads, make sure you stay to the end of the video because I will show you a better way to go about it. But if you are new to selling options, let me show you how this works. All right, so first off, selling puts. The objective of selling puts is to 1, generate income or to buy a stock at a lower price than what it's trading for today. All right, generate income and buy stocks at a lower price. Those are the 2 reasons that you would sell puts for. And selling puts is very equal to selling insurance to someone. So you can kind of think of selling puts as selling car insurance. Now you probably have car insurance for your car, and the only reason you have that is because you're fearful that you may someday get into a crash. And if you do, you want your car insurance company to pay for all the liabilities. Well, selling puts is the exact same thing, but instead of insuring a car crashing, you're insuring a stock crashing. And this is how that will work. Let's say we have ABC stock that's selling for $100 currently. And there's somebody who owns the stock and they just want to buy insurance just in case the stock price were to drop. Those are the put buyers. Well, we will come in as the put sellers and say, okay, your ABC stock is selling for $100 right now. I will insure your stock and buy it off you if it drops down to $85. So $85 is our strike price. And we're going to make this contract 30 days long. But for me insuring your stock, you have to pay me $200 up front right here, right now. And I keep that $200 regardless of what happens. Just like your car insurance company keeps the money that you send them every month, whether you get into a crash or you don't. So from here, one of 2 things can happen. If that ABC stock, which is currently at $100, stays above that $85 throughout those 30 days, you just keep your money and you go about your life, and then you can continue to do that exact same trade over and over and over again if you want to. And that is often the most desirable outcome. However, step number 2 is if ABC stock were to drop down below the $85 strike that we had, well, then we need to purchase 100 shares of that company per contract. But we still keep the $200 that we were paid initially. But oftentimes, even that number 2 option is still great, because if you do this on a company that you would like to own anyway, then you essentially got paid to wait around and buy a company at a cheaper price than what it was when you originally looked at it. So selling puts, you're either getting paid to wait or you're getting paid to buy something at a cheaper price. So let's look at an example. All right, so here we have a put seller, which is you, and then we have a put buyer on the other side, and we have Apple stock. Let's say it's currently trading for $175. Well, you'll come over to the buyer like, hey, I will insure your stock at a strike of $165 for 30 days out. But for doing that, you have to pay me $200 right here, right now. And y'all both agree, and then the buyer pays you the $200 right here, right now. Well, if we look over here at this chart, as long as Apple stock stays above $165, you just keep your money and you go about your day, all right? However, if it drops below that 165, then you will need to purchase the shares. Or if you decide that you no longer want to purchase the shares, you can just close out of the trade at a loss. However, that is why it's good to do this on companies that you would like to buy anyway. And make sure you stay to the end, because we will do a live trade and show you how to do this and the data points that I look at prior to entering into any trade. But before that, now let's look at credit spreads. All right, now credit spreads. If you have a smaller account, then credit spreads will likely work out much better for you than selling puts would. And I'll show you why in just a second. But the objective of credit spreads is to generate income and profit from the stock price staying above or below your strike price, depending on what type of credit spread you're doing. And you may also hear credit spreads referred to as vertical spreads. Now with bull put credit spreads, they are very similar to selling a put. However, now you're still going to sell that put, but now you're going to buy a put at a strike that is further from the money. So in that last example I gave you, we had ABC stock trading at $100 and we sold that put at $85. Well, now what we'll do is we'll go ahead and buy a put at anywhere under 85. So in this case, let's say we buy a put at $80. So we sold a put at 85 and we bought a put at $80. That creates a credit spread. So let's take a look at this example here. All right, so in this example, we have a stock that is selling for $81 currently. So what we can do is we can sell to open a put at $73 and then buy to open a put at $70. And for doing so, we received $100 and our max loss would be $400. And here's why. Your max loss with credit spreads is always the distance between the strikes times 100 minus the premium. So the distance between $70 and $75 is $5. And if we times that by 100, it's $500. However, we received $100 for the trade. So we have to subtract that, and that gets us at $400. So as you can see from this chart here, as long as the stock price stays above $75, we just make our money and go about our day. However, if it does start to drop, then we will start to lose money, but we won't lose any more than that $400. And because this is a defined trade as far as how much you can lose, your brokerage will allow you to put on this trade as long as you have at least the max loss in your account. So really all you would need in order to put on this trade is $400. But before I show you the data points that I look at prior to making a trade and showing you a live trade, we need to select the stock or the ETF that we're going to be trading. And part of the reason I'm able to get outsized gains when it comes to trading is I utilize what's called leveraged ETFs. Now, if you're not familiar with leveraged ETFs, they are simply ETFs that look to either 2x or 3x the performance of a stock or specific sector on a daily basis. So for an example, if there's a leveraged ETF that follows Apple, if Apple were to move up 1% for the day, a leveraged ETF will look to move up like 2 or 3% for the day. And the same works in reverse. If Apple were to move down 1% for the day, a leveraged ETF will look to move down 2 or 3% for the day. And because of that extra volatility that the leveraged ETF has, that makes the option premiums even higher. And as an option seller, that is exactly what we want. Because if the option premiums are higher, that means we are collecting more money up front. And one of my favorite leveraged ETFs to trade is ticker symbol. But another way to earn 7 to 9% on your money monthly is by owning your own business. And that's where today's sponsors, Limits Express Company, comes in. They will completely manage an Amazon store for you selling products like Colgate, toothpaste, Crest mouthwash, Dove soap, and many more. Limits Express will handle everything from product sourcing to customer service, allowing you to earn 100% passive income. To secure the best prices and maximize profits, Limits Express needs to purchase large quantities of inventory. They achieve this by pulling funds from their clients, which enables them to place bulk orders with suppliers at significantly discounted prices. And this is why I love this company. This model ensures that Limits Express success is directly tied to your success. They only make money when you do. Your role is to provide the necessary capital for inventory, and in return, Limits Express does all the rest. It's like a collaborative partnership where you share the profits, but the workload is put on the experienced professionals. Listen, I love the stock market, but if you invest in the S&P 500, you'll average about a 10% annual return. With this Amazon business, you can get nearly the same amount monthly while still being totally hands-off. If you're interested in making passive income on Amazon, use the link below to book a 30-minute Zoom call directly with one of their co-founders, Kyle. He will explain everything to you so you can see if it's a great fit for you. The link is in the description below. And one of my favorite leveraged ETFs to trade is ticker symbol SOXL. So SOXL is simply the semiconductor industry. So if we look up here, we can see that there are 37 different companies within this single ETF, but we have huge names such as Broadcom, NVIDIA, AMD, Qualcomm, Texas Instruments, Lam Research, so forth and so on. And I am still very bullish on semiconductor stocks. I don't think the AI boom is anywhere near over, and that has been made very apparent by the growing cash flow in companies such as NVIDIA. But if we look at SOXL a little further, so it's currently a $29 stock, and this ETF has $9.7 billion under management. And if we look at the implied volatility, it is currently at 82%, which is pretty high, which is exactly what we want as option sellers. But let's take a look at SOXL's chart. Now, there's only one technical indicator that I use for this type of strategy. So I'm not sitting around looking at charts all day. I can see a chart within 2 seconds and get the information that I need from it. But that technical indicator is called the Bollinger Bands. So if we look here, those are these black lines, but a Bollinger Band just aims to show you the range that a stock is expected to trade within. And usually Bollinger Bands are about 95% accurate. So if we look here, we can see that it has a range of $26.61 up to $31.70. And if you notice, the few times that it bounces out of the Bollinger Band, it quickly goes back in. So it came down out of the Bollinger Band here, popped back up. It went out of the Bollinger Band here within a single day, popped back in, and the same thing just keeps happening. Once it pops out, it's very quick to pop right back in. But because I am bullish on SOXL, I just want to pay attention to this bottom number. So it is expected to stay above $26.61. So that is the first thing that we want to keep in mind. But let's head over to Thinkorswim and look at the second data point. So now I have SOXL pulled up in the options chain. And the next thing we need to do is select our expiration date. Now, if you want to make sure this is 100% a swing trade, then you just need to select an expiration date somewhere within 7 days. And so we could do that, but I'm going to show you a better way. So first off, if you did want to keep it within 7 days, then you'll just select whatever expiration is within 7 days. So this one is within 5 days, so we'll select it, and then we'll come over here to the put side. And now the second set of data that I want to look at is the delta. So the delta column is here, but delta just shows you the probability of an event occurring. So we can see right here at this $24.50 strike, it has a delta of 0.05. That is saying that there is a 5% chance that SOXL's stock price currently drops down to that $24.50 strike by this expiration date 5 days out from now. In other words, for this strike, you would have a 95% probability of profit. Now, for me, I like to stay below a delta of 0.20. However, I have a very large account and I'm able to do a lot more contracts than most people are able to do. And so because of that, I like to go a little bit more conservative. However, if you have a slightly smaller account, how I built my account was using a delta of 0.30. So I would come down here, we can see that this strike right here of $28.50 is a strike of 0.31. Now, if we were to sell a put right now, we will receive anywhere between $56 and $68 right here, right now. All right, so you can see it shows 0.56 and 0.68 there. If you're new to options, that is the price you'll receive per share, but every contract is worth 100 shares. So you'll just multiply whatever you see here by 100. So you will receive anywhere between $56 and $68. And that trade would be great. You will receive about a 2% return on this trade in just 5 short days. However, let me show you a better way to go about it. What I would do is I would go out for an expiration a little further out. So I would probably come down to this expiration that is 33 days out from now. And if we come back over to the put side, if we recall from the Bollinger Bands, the lowest point was $26. So I just want to be somewhere near there while staying below a delta of 0.30. So if we come over here, it looks like the strike of $27 is 0.30. But let's say I want to be even more conservative. I want to be below what that Bollinger Band said. We'll go up to the strike of $26, which puts us at a delta of 0.26. And if we were to sell a put right here, right now, we will receive anywhere between $128 and $171. Now, here's how it can still be a swing trade. I would likely close this trade once I am up by 50 to 80%. And it doesn't take much for that to happen. If SOXL has some pretty decent green days here soon, very similar to what it had on this most recent day, which it was currently up 7%, then I could be up more than 50% and close out of the trade in a few short days. But let's go ahead and place the trade. So in order to place the trade, I will come over to the $26 strike that we selected, and I will right click and hit sell. Hit single because it is a single leg trade. And now I need to select the amount of contracts that I would like to do. And this is totally up to you depending on how large your account is and how much risk you would like to take on this single stock. But let's say just for an example, you wanted to do 5 contracts. So I'll select 5 there and I'll come over here to the premiums and I'll select the mid price as always. And so that would get us about $149 per contract. And then hit confirm. And we can see here at our max profit for this trade would be $745, and we will receive that money immediately upon entering into the trade. And if we look at this column here, our max loss says $12,255. Now don't let that number scare you. That is just showing you what you could lose if SOXL were to go down to 0 while you had your contracts open. And seeming as we're trading an ETF that has 37 different companies in it, with most of them being very, very large companies, the chances of that happening are very, very slim to none. All right, but once you like what you see, you can just hit the send button in order to enter into the trade. But now let's do a credit spread. Now with credit spreads, because it's a two-legged strategy, you will have to be a little bit more aggressive when it comes to your strike price selection in order to get the same amount of money that you would if you were just selling the puts. So what I may do, instead of that $26 strike, I will select the $27 strike, which is still at the delta of 0.30. So I'll come over here, I'll hit sell, and then I'll go to vertical. All right, because this is a vertical spread. But now what we need to do is select what strike we would like to buy to open. All right, so we're selling to open the $27 strike, and now we need to buy to open a strike that is lower. And for me, I'm going to select this strike of $20. So I'll come over here and I will find 20 and select it. And then same thing, we need to come over here and select the amount of contracts that we want. We will keep it right at 5. And then at the mid price, we will receive $141 per contract. So let's hit confirm. So now if we look at our max profit line, we're getting $705, which isn't far off from the amount we were getting from selling puts. But now if we look at our max loss for this trade is only $2,795. And so if you have a smaller account, as long as you have $2,795, you could put on this exact trade right now if you wanted to. But there you go, a super easy swing trading strategy. If you would like to learn more from me, come and join the Trade to Freedom community. The link is in the description below. Not only will you get my real trades in real time as soon as I enter them, but you'll also get my entire options framework, and thirdly, you'll be in a community of people that have the exact same goals as you. So come join us. It's a new year. Let's hit those goals together. But I'll see you guys in the next video. Peace.